Oil plays a central role in the global economy, not only as a source of energy, but also as a powerful force that influences currencies, trade balances, and financial stability across nations. One of the most important reasons oil affects global currency markets is because it is traded almost exclusively in US dollars, a system commonly referred to as the petrodollar system. This arrangement has shaped international finance for decades and continues to impact exchange rates, inflation, and economic power worldwide. When countries buy or sell oil, they do so using US dollars rather than their own national currencies. This single fact creates a strong and continuous demand for the dollar, giving it a dominant position in the global financial system. The petrodollar system was established in the 1970s, when major oil-producing nations agreed to price oil exclusively in US dollars. In return, the United States offered economic and military support to oil-exporting countries, particularly in the Middle East. This agreement ensured that any country wishing to import oil would first need to obtain US dollars, regardless of its own currency. Since oil is essential for transportation, electricity generation, manufacturing, and nearly every aspect of modern life, all nations are forced to participate in this system. As a result, the dollar became deeply embedded in global trade and finance, strengthening its position as the world's primary reserve currency. When oil prices rise, the demand for US dollars increases significantly. Countries that import oil must spend more dollars to purchase the same amount of energy, which puts pressure on their foreign exchange reserves. To meet this demand, governments and central banks often need to buy dollars in international markets, causing the dollar's value to rise relative to other currencies. At the same time, their own currencies may weaken because more of their national wealth is flowing outward to pay for energy imports. This imbalance is especially harmful for developing countries that rely heavily on imported oil and have limited dollar reserves. As oil becomes more expensive, these nations face rising costs, currency depreciation, and growing trade deficits. The strengthening of the US dollar during periods of high oil prices creates a ripple effect throughout the global economy. When the dollar rises, it becomes more expensive for other countries to service dollar-denominated debt. Many developing nations borrow in dollars because it is more stable and widely accepted. But when the dollar strengthens, the cost of repaying those loans increases in local currency terms. This can lead to higher debt burdens, reduced government spending, and slower economic growth. In extreme cases, it may even trigger financial crises or force countries to seek assistance from international institutions, such as the International Monetary Fund. At the same time, a strong dollar tends to weaken other currencies, making imports more expensive for non-dollar economies. This contributes to inflation, especially in countries that rely heavily on imported goods and energy. As fuel prices rise, transportation costs increase, which in turn raises the price of food, consumer goods, and industrial products. Inflation erodes purchasing power, meaning people can buy less with the same amount of money. Central banks may respond by raising interest rates to control inflation, but higher interest rates can slow economic growth and increase unemployment. Thus, rising oil prices indirectly affect employment, living standards, and economic stability through their impact on currency values. Oil exporting countries, on the other hand, often benefit when oil prices rise. Because they receive more dollars for their exports, their foreign exchange reserves increase, and their national currencies may strengthen. Countries like Saudi Arabia, Russia, and other major oil producers experience higher revenues during oil price booms, which can lead to increased government spending, stronger fiscal positions, and improved trade balances. However, even for these nations, heavy dependence on oil revenues can be risky. A sudden drop in oil prices can quickly reverse economic gains, weaken currencies, and create budget deficits, demonstrating how closely oil prices and currency stability are linked. The influence of oil prices on global currencies also affects international trade patterns. When the dollar strengthens due to rising oil prices, exports from the United States become more expensive for foreign buyers, while imports become cheaper for Americans. This can widen trade deficits and alter global trade flows. Meanwhile, countries with weaker currencies may find their exports becoming more competitive, but they also face higher import costs, especially for energy and raw materials. These shifts can change global supply chains and economic relationships between nations. Another important aspect of the petrodollar system is its impact on global financial markets. Because oil transactions require dollars, many countries hold large reserves of U.S. Treasury bonds as a way to store and manage their dollar holdings. This creates steady demand for U.S. government debt, allowing the United States to borrow at lower interest rates than most other nations. In effect, the global dependence on oil strengthens the U.S. financial system and gives the dollar a unique advantage that no other currency currently enjoys. However, this also means that any major change in oil pricing, such as a shift to alternative currencies or widespread adoption of renewable energy, could significantly reshape global financial dynamics. In recent years, there has been growing discussion about reducing reliance on the dollar in global oil trade. Some countries have explored using alternative currencies or local currency agreements to settle energy transactions. While these efforts have increased, the dollar remains dominant due to its liquidity, stability, and widespread acceptance. Transitioning away from the dollar would require deep structural changes in global finance, which are difficult to achieve in the short term. As long as oil remains essential to the global economy and is priced in dollars, the link between oil prices and currency values will continue to exist. In conclusion, oil prices have a powerful influence on global currencies, primarily because oil is traded in US dollars. When oil prices rise, demand for dollars increases, strengthening the dollar and weakening other currencies. This affects inflation, trade balances, debt repayment, and economic stability across the world. Countries that depend heavily on oil imports are especially vulnerable, while oil exporting nations often benefit in the short term. The petrodollar system has made the US dollar central to global finance, giving it unmatched influence over international markets. As long as oil remains a critical resource and continues to be priced in dollars, fluctuations in oil prices will remain one of the most important forces shaping global currency movements and economic conditions worldwide. Oil plays a fundamental role in the modern global economy, and its price has a direct and powerful impact on inflation and overall economic stability. Because oil is used in transportation, electricity generation, manufacturing, agriculture, and nearly every sector of production, any increase in its price quickly spreads throughout the economy. When oil becomes expensive, the cost of moving goods rises, factories face higher operating expenses, and energy bills increase for households and businesses alike. These rising costs are eventually passed on to consumers in the form of higher prices for everyday goods and services, leading to inflation. Inflation occurs when the general price level of goods and services rises over time, reducing the purchasing power of money. Oil-driven inflation is particularly dangerous because it affects multiple layers of the economy simultaneously. For example, higher fuel prices increase transportation costs, which raise the price of food, clothing, and consumer products. Electricity generation becomes more expensive, pushing up utility bills for homes and industries. Manufacturing costs rise as factories pay more for energy and raw materials. As these increases accumulate, the overall cost of living climbs, and consumers are forced to spend more for the same standard of living. When inflation rises due to higher oil prices, a country's currency often weakens. This happens because inflation reduces the real value of money. Investors and foreign traders lose confidence in a currency that is rapidly losing purchasing power, leading them to move their capital elsewhere. As demand for that currency declines, its value falls in foreign exchange markets. A weaker currency then makes imports even more expensive, further worsening inflation in a dangerous cycle known as cost-push inflation. Oil importing countries are especially vulnerable to this problem. Nations that rely heavily on imported oil must spend more foreign currency when oil prices rise. This increases their trade deficits, as more money flows out of the country to pay for energy. Over time, this puts pressure on foreign exchange reserves and weakens the local currency. As the currency depreciates, imports become even more expensive, further fueling inflation and reducing purchasing power. Developing countries are particularly affected because they often lack strong financial buffers and depend heavily on imported fuel for electricity and transportation. In many oil importing nations, rising oil prices also increase government spending. Governments may be forced to provide fuel subsidies to protect citizens from rising costs, which places strain on national budgets. If subsidies are removed, public dissatisfaction can rise due to higher living expenses. If subsidies are maintained, fiscal deficits increase, leading to higher borrowing or money printing. Both scenarios can weaken the national currency and destabilize the economy. Central banks often respond by raising interest rates to control inflation, but this can slow economic growth, reduce investment, and increase unemployment. On the other hand, oil exporting countries often benefit when oil prices rise. Higher oil prices mean greater export earnings, increased government revenues, and stronger foreign exchange reserves. These inflows of foreign currency strengthen their national currencies and improve their trade balances. Countries such as Saudi Arabia, Norway, Russia, and other major oil producers typically experience economic expansion during periods of high oil prices. Their governments may invest more in infrastructure, social programs, and development projects, boosting overall economic growth. However, even oil exporting nations are not immune to economic risks. While high oil prices strengthen their currencies, they can also lead to overdependence on energy exports. When a country relies too heavily on oil revenues, other sectors such as manufacturing, agriculture, and technology may weaken. This phenomenon, often referred to as the resource curse, can make an economy vulnerable to sudden drops in oil prices. If global demand falls or alternative energy sources become more widespread, oil prices may decline sharply, leading to budget deficits, currency depreciation, and economic instability. The relationship between oil prices and inflation also affects global financial markets. Rising inflation often prompts central banks to increase interest rates to control price levels. Higher interest rates make borrowing more expensive, slowing business expansion and consumer spending. Stock markets may decline as companies face higher costs and reduced profits. At the same time, higher interest rates can attract foreign investment, temporarily strengthening the currency. However, this effect is often short-lived if inflation remains high and economic growth slows. Another important factor is how oil price changes influence investor confidence. When oil prices rise sharply, it can signal economic stress or geopolitical tension, causing uncertainty in global markets. Investors may shift their money towards safe haven assets such as gold or stable currencies, further affecting exchange rates. Conversely, falling oil prices may indicate weakening global demand, raising concerns about economic slowdown or recession. For oil-importing developing countries, the impact is often more severe. These nations usually spend a large portion of their export earnings on energy imports. When oil prices rise, they must either increase borrowing, reduce essential imports, or devalue their currency. All three options can harm economic growth and living standards. Inflation hits low-income populations the hardest, as food and transportation costs consume a larger share of their income. This can lead to social unrest, political instability, and long-term economic challenges. Oil prices also influence government policy decisions. Rising inflation forces central banks to choose between controlling prices and supporting economic growth. Tight monetary policy can reduce inflation, but may slow economic activity and increase unemployment. Loose monetary policy may support growth, but risks worsening inflation and weakening the currency. Striking the right balance becomes increasingly difficult when oil prices remain high for extended periods. In the long run, the impact of oil prices on inflation and currency values highlights the importance of energy diversification. Countries that invest in renewable energy, energy efficiency, and alternative fuel sources are better protected from oil price shocks. By reducing dependence on imported oil, they can stabilize their economies, protect their currencies, and control inflation more effectively. This is one of the reasons many nations are now focusing on renewable energy and energy independence as part of their long-term economic strategy. In conclusion, oil prices play a crucial role in shaping inflation and economic performance around the world. When oil becomes expensive, production and transportation costs rise, leading to higher prices and reduced purchasing power. Inflation weakens currencies, especially in oil-importing nations, while oil-exporting countries often benefit from stronger revenues and currency appreciation. However, both groups face risks if they rely too heavily on oil. The close connection between oil prices, inflation, and currency values makes energy one of the most powerful forces in the global economy, influencing everything from household expenses to international financial stability.